Take a look at this chart tracking Dash's price history. In December 2017, this asset peaked at over $1,600. Today, it trades around $38. That is a brutal 97% collapse in value. In the cryptocurrency space, a drop of that magnitude over multiple market cycles usually points to a single conclusion. The developer team walked away, the users left, and the project is entirely dead. But the network activity tells a completely different story. Right now, this supposedly dead coin is aggressively processing fast, cheap, peer-to-peer payments across emerging markets on a massive scale. We have a catastrophic chart reality sitting directly on top of a highly active, thriving global payment rail. That massive discrepancy is exactly where smart money finds opportunity, and it requires a closer look. Dash, which stands for digital cash, has been around since 2014. Developer Evan Duffield built it as a direct branch off the Litecoin network, specifically engineering it to bypass the slow transaction times and high fees that were crippling early cryptocurrencies. To solve those bottlenecks, Duffield abandoned the traditional single-layer blockchain model. He split the network's duties into a unique two-tier architecture. Looking at the network structure, you can see how the labor is divided. A wide base layer relies on traditional miners to handle heavy cryptographic security. Above that, a distinct top layer of specialized servers, called masternodes, handles instant settlements, optional transaction privacy, and protocol governance. By offloading complex, rapid-fire operations to this dedicated upper tier, the base layer avoids congestion. That specific mechanical division is the reason Dash survived a decade of crypto winters while almost all of its early competitors broke down and vanished. To understand where the asset is headed, we have to look at the tokenomics. Dash has a strict maximum supply cap of roughly 18.9 million coins, with about 12.7 million currently in active circulation. Remember those masternodes from the top layer of the network? Operating one comes with a steep physical cost. An investor is required to put up collateral by locking exactly 1,000 Dash tokens into an unspendable state. The network creates intense motivation for investors to do this by handing those masternode operators a full 45. When you combine aggressively tapering emissions with constant, massive chunks of token lockups, you get a severe supply squeeze. It acts exactly like a coiled spring under the surface, completely masked by the terrible historical price action. But invisible upward pressure means nothing if the broader market refuses to participate. Right now, this relentless macro selling sentiment continues to physically suppress the price around that $38 mark. This candlestick chart of recent price action reveals the immediate battlefield. The absolute most critical technical threshold for traders is this hard resistance wall sitting at exactly $50. Every attempt to break above it has been rejected. Reclaiming and holding that exact $50 level is the required first signal that a lasting momentum reversal is actually underway. The tokenomics squeeze we just broke down is fascinating, but it is effectively irrelevant to your portfolio unless the asset generates enough sheer force to trigger that $50 breakout. If we step away from the charts, the real-world utility of Dash is undeniable. Its physical adoption as an everyday point-of-sale payment rail in these emerging economies is highly successful and expanding rapidly. However, the network's technical design carries a fatal flaw for Western markets. The protocol includes optional features that allow users to obscure transaction details. That places Dash firmly in the privacy coin category. In the current compliance landscape, that label acts as a regulatory magnet, triggering forced, unceremonious delistings across the major centralized crypto exchanges. This creates a difficult paradox. The asset is succeeding brilliantly at its original mission to serve as borderless digital cash, but the specific technology enabling that success makes it incredibly difficult to hold and trade as a mainstream investment. Taking all the data into account, Dash earns a cautious watch rating. The ongoing threat of exchange delistings presents a severe risk to liquidity that you cannot ignore. Despite that regulatory danger, the constant mechanical absorption of circulating supply by masternode operators provides a structural floor that stops the asset from going to zero. The strategy here is strict. Keep your capital on the sidelines until you see a confirmed daily close above that $50 resistance line. This 2014 pioneer has the underlying math to survive, but it is fighting a brutal battle for relevance in 2025. What do you think? Is this project entirely dead, or is it a sleeping giant? Let us know in the comments, subscribe, and tell us which coin you want covered next.